So as Joel mentioned, I look after something in Platts called the price group. We are the custodians of the core part of Platts, which is the price assessments for oil, for shipping, for a lot of these commodities, the numbers we publish that are then used in physical contracts, in derivative contracts around the world. And as you've heard from Joel, in these markets in the last year, 2 years, there's been considerable change. There's been a lot of volatility, and that volatility is still there in the market. Now, on the one hand, people in the market can enjoy that volatility for trading, but for a lot of those stakeholders in the industry, volatility is a difficult thing to manage. And what it indicates is that the market has yet to find equilibrium. It hasn't found a new sustainable position. And what that means for us is that we have to be prepared for all of the changes that may yet come. So what I'm going to talk through are 3 of the key areas that we've been focusing on in terms of crude oil pricing around the world. We're going to start with a look at the North Sea. Then we'll shift east and talk around Middle East, crude oil pricing, Dubai, and finish off with a brief look at the US exports phenomenon and what that may mean within oil benchmarks. Just going to stop the slides for a minute. In the North Sea, we have, over a series of decades, evolved our key assessment, dated Brent, to account for the changes in production that we've seen. You go back to the 1980s, and single Brent stream was sufficient to drive a very clear, transparent crude price. Over time, that's declined. We've added in other streams, created a basket of crude oils. You now have Brent, Forties, Oseberg, and Ekofisk. And we've changed the timing, extended it a little bit, all of which has helped to create a very robust daily price for crude. Can you take away the funny slide? Just go back to where it was. People messing around with my slides, man. But dated Brent has reached a crossroads, a very important point in its future. As you look ahead over the next 5 years, it becomes clear that there are 2 paths that can be taken for North Sea crude. One of those paths is that North Sea crude oil as a benchmark price remains the price of crude oil coming out of the North Sea, loading in the North Sea. But that is a crude oil that is changing quite dramatically in terms of its specifications, the grade that is behind it. The other path is to say that the value of North Sea crude is the value of sweet light oil in the North Sea, and therefore needs to encompass something much more global. Now, we have been working very closely with the market over the last, several years, but particularly in the last several months, to make this question a key part of conversations. And the first step we took in this process was to create a new assessment, something called CIF Rotterdam dated Brent. The idea with this is that if you have 2 paths ahead of you, you need to have at least the path laid down before you take a step. FOB North Sea, crude oil loading out of the North Sea, has a path laid down. We've now laid down a path for the possibility of North Sea as global crude coming into Rotterdam. We started that in February of this year. Sorry, March of this year. We announced it in February. And the next question is, over the following months, over the following year or so, working with the industry, which of these two directions do we move on? If you look at the North Sea itself and the crudes that are coming out there, at the top here, you can see the existing basket that feeds into dated Brent. You've got Brent, you've got 40s, which is really the driving grade on a day-to-day basis of dated Brent as an assessment. And you've got Erzberg and Ekofisk. When you look at other grades in the North Sea, you can see here Flotte Gold, Troll, Duk. You are looking at already crude oils that are heavier, that typically trade at a discount to the existing dated Brent structure. They move the benchmark into a quite different direction. And when you look further ahead, not shown here, are the large new grades coming up over the next 5 years in the North Sea. There's one called Johan Sverdrup, others, and many of these are very heavy grades, APIs of under 30. Some of them are sulfurous, some of them are high acid, high tan. They change the benchmark, but if you want to reflect the loading of oil from the North Sea, these would have to be incorporated. Now, at the moment, there's around about the volume of crude that is produced for the 4 key grades is close to 1 million barrels a day. It's come up in the last year or two as we've seen a recovery in production in the North Sea. But if you look forward 5 years, 10 years, those 4 grades lessen and reach a point at which you really need more in that basket to ensure a very robust price for this key benchmark. If you look outside of just those existing 4 grades and the ones that are there in the North Sea that are loading, you start to hit, well, you can see here obviously Urals, very large production coming into Rotterdam on a CIF basis. CPC, also very large production and a much lighter grade. And then you move into West Africa and the upcoming North Sea grades that I mentioned that are really very different types of crude, whether you've got the exceptionally heavy grades, Guarana coming up 24 API, or those that are essentially the opposite direction and just very small and not really going to have an impact on crude pricing in the North Sea. The CIF dated price that we launched in March has already shown a lot of similarity with other CIF grades coming into coming into Rotterdam. This is the price in red that we've been publishing for CIF Rotterdam. There are other CIF North Sea grades that are delivered into Rotterdam. 2 key ones here, Statfjord and Gullfax. You can see actually sit very close to the existing basket. The concept of a CIF Rotterdam price actually has a lot of resonance with the broader market and sits within a range of crudes that could perform quite well together as a price discovery process. Of the crude going into Rotterdam, just about a majority is still coming from the North Sea. But there's a large volume that's coming from Middle East, Baltics, West Africa. Truly, it's a global market. And a CIF basket that was able to encompass these other grades would, of course, continue to ensure that dated Brent was globally relevant in the way that it is now. Now, we haven't yet reached a conclusion in which of these 2 paths we will take with our assessments. We're going to be holding a workshop with the industry in London in November to advance this conversation. and say, okay, look, this is what the concrete next steps would be. But you have to remember, dated Brent as a benchmark is used to price the majority of the world's physical crude oil. And it's very important as we move ahead that everyone is part of that conversation so that it remains robust and relevant in the years ahead. Now, of course, a very important part of the European crude oil picture is the flow of crude oil out of Russia, the Urals. And Urals is very much going to be part of our conversation with the industry, with stakeholders over the next year as well. Significant volume of crude with two key markets that we look at, the Mediterranean and Rotterdam, Northern Europe. We're going to discuss this in a lot more detail later on this morning during our panel. But just to highlight what we've been looking at with that is, again, further evolution of our assessments of this key crude. We've seen the Mediterranean flow shift more towards a CIF marker, and we have incorporated into it a broader range of deliverable timings for that crude. We're looking at a similar model for the CIF Rotterdam Urals assessment, and eventually we may see those two benchmarks become much more intertwined through steps we're going to be taking over the next couple of years. But I'm going to leave that to one side because we'll spend more time on it in a little bit. If we look east, of course, Russian crude oil has been a very important part of the Asian crude slate over the last several years. ESPO has been particularly favored by a number of refiners in the region. More recently, we saw the teapots, the independent refiners in eastern China, take up a lot of ESPO crude. For many years, there's been discussion around, well, when and how will ESPO form part of global benchmarking? And certainly ESPO has the potential to be a very important part of any future Far East crude oil benchmark. At the moment, we've seen a decline in spot availability of ESPO. There's been a lot more of that crude has been tied up in long-term contracts. And that's meant that we've actually seen less transparency, less trade, less fungibility around ESPO. But over time, we do see ESPO forming a core part of the benchmark complex out there. And the discussion now is, okay, how does ESPO fit with the other regional crude grades? Do we change how we look at it and how we assess it so that it lines up more closely with, for example, Southeast Asian crudes? Do we look at something down the line of an ESPO partials system, somewhat more akin to dated Brent? And could ESPO form the core of a basket in the Far East in the way that Brent formed the beginnings of a basket and consequently the brand name of a basket in the West? Move away from that future and now talk a little bit around current affairs in Asia in terms of crude oil. Some of you may have followed in the last couple of years the very large growth in spot activity in Asia in crude oil. Our assessment of Dubai, we have a basket of crudes that is reflected in Dubai crude oil. Historically, in the last couple of years, has been Oman, Upper Zakum, and Dubai, with Dubai a very small part of that basket. Much akin to Brent in the North Sea, it's a brand name for a whole group of crudes. The last few years, we saw spot activity in that market well over double-digit growth every single year. And a large part of that growth has been due to the increasing activity of Asian companies in crude spot markets. If you go back 5 years, the most active companies in the spot physical markets in Asia would have been European and American majors, banks, trading houses. That is no longer the case. The most active companies in Asia, in the crude and the oil products markets, are Chinese, Indian, Russian, as well as those traditional Western majors and banks. Now, particularly those Chinese majors, they are extremely large in terms of the systems that they operate, not just domestically, but across the whole region. And their capacity to trade crude is that much larger than those in the West. So their activity in these spot markets has been very, very, very high. We've seen months where one of those companies has been able to buy 80 cargoes of crude in a single month, more than any Western major ever could. We've seen over the last couple of years, China Oil and Unipec be the two key participants in the crude spot markets in Asia. You can see here Shell, Vitol, some of the other traders. Historically, their activity in these markets, in an absolute sense, has continued to grow. It hasn't reduced. But the overall market has grown so much because of the entrance of these other companies. Now, if you have the world's largest refiners, the most active traders, all in a single market, and you've got the world's single largest importer of crude oil, which is China. China has continued to see growth of net crude imports and overtook the US at points. That means that that country is very important within Middle East crude. There are points when Oman crude, which is freely traded and can go anywhere in the world, and indeed recently was going to the US, just as US crude has been coming out into Asia. But quite often you see 80%, 90% of Oman crude oil going to China on any given month. China particularly favors Middle East crude, particularly favors Oman. The domestic refineries were constructed to run on domestic Chinese crude that looks very similar in terms of yield specifications to Omani crude. That's why you hear of the independent refiners taking so much of this crude. But if you've got that amount of activity in a benchmark, you need to ensure that the benchmark is big enough to be able to cope with the biggest companies. At the end of last year, we started a consultation with the market to evolve that Dubai basket to ensure that when these very large companies were trading spot crude oil, that the basket itself was large enough to continue to reflect a robust, stable price. The beginning of this year, we added in 2 new crudes to that basket. So you can see here, way back when Dubai crude was a single stream, had been 500,000 barrels a day of crude oil and reduced over time. We added in, first of all, Oman to that basket in 2002, and then Upper Zakum in 2006, each time adding significant volume of crude. This year, we've added in Al Shaheen, which is about 350,000 barrels a day of crude. And that as a grade is freely traded. It comes out of Qatar and actually looks quite similar to Oman in terms of its yield. And we also added in Murban, which is the top one here. Now, Murban is a very different grade. Murban is a light sweet crude. In many ways, it looks actually a lot more like Brent. But Murban is one of the largest single crude streams in the world, 1.6 million barrels a day. If you have extremely large companies trading a lot, this is the crude that essentially means the spot market will always be able to cope with the volume of trade that is happening there. We didn't just add in crudes that had some volume, but also crudes that are very reflective of the whole region. So Al Shaheen goes pretty much to every refiner in Asia. It hasn't actually historically gone to China, but it goes as far afield as New Zealand, certainly to Singapore, India, across the whole region. And by adding that into the basket, wherein you have some crudes that are very much focused just on going into China, it ensures that it's very much retains a broad focus. Since we've added in those new crudes, we've seen Al Shaheen be a very important part of the day-to-day process that feeds into Dubai. This just shows you the crude oils that have been delivered through the Platts market on close process for Dubai. About half of the time it's been Upper Zakum, half of the time it's been Al Shaheen, or maybe 40, 45, and then a little bit of Oman getting delivered in as well. Very quickly, the market has embraced Al Shaheen as a key part of the new basket there in the Middle East. Murban hasn't been delivered into it. As I said, it's a much lighter crude. Light sweet crudes tend to be priced at a premium to the heavier sour crudes. We have announced that we're introducing from actually the end of next week a new mechanism into this basket, something called a quality premium, which is a mechanism we already have in the North Sea and brings a divergent range of grades into a similar value space. So in the North Sea, Osberg and Ekofisk have quality premiums that mean that they can form part of a benchmark with 40s, which is a heavier grade. In the Middle East, quality premium is going to come into the process to make Murban a closer fit to the existing basket. Now, if you look, this is not quite the most recent data, but it's May 2016. This shows you the activity of companies in that same process. And you'll see that already it's become quite a lot broader in terms of participation. Yes, China Oil, Unipec have been active participants, but we've also got SK Energy, Korean refiner. We've also got Total and Reliance, Japanese traders. The activity has broadened out quite a lot after the introduction of these new grades. That's very important to us, that we continue to reflect a market that remains very much global, very much something that is open to a range of participants and attractive to a range of participants. I'm quite conscious of time, so I'm not going to dwell too much on this. This is the quality premium that I just mentioned on Murban. I'm going to finish off with looking west and what's been happening as a result of the US exports. Now, as Joel mentioned, there was a long period when people would just talk around WTI as a, say, was it a broken benchmark? And as he said, it wasn't that it was broken, it's that it was doing what it was supposed to do, which was be a domestic marker. Historically, that domestic marker was important to the rest of the world because the US was an extremely large importer of crude oil. So if you were elsewhere in the world and you wanted to know, well, where's the easiest place for me to send my crude? Well, that would have been the US. But we've seen those US imports fall back quite rapidly in the last few years. And as a result, that domestic US price was no longer really a driving force in the international markets. Instead, the market looked to waterborne grades such as dated Brent, such as Urals, such as Dubai, as really the key indicators of the international value of crude oil. Now the US has said, okay, well, US crude can also be part of that market, can be exported, can be part of the international waterborne market. So we're very interested by this. We ourselves said, okay, right, for this to be part of the international mix, there needs to be transparent pricing around it. So we started assessing grades of crude oil out of the US Gulf Coast from February. Not just WTI, but also Eagle Ford, and also the kind of the ultralight, the condensate coming out of the Gulf Coast as well. You know, if US crude is going to be relevant to international benchmarks, you need to know what the actual export price of it is. And it turns out that's actually quite a different thing from that domestic price. Obviously, we'd all known this, seeing WTI disconnect from Brent over the years. But what's the actual price of US crude on the international market? Well, you can see here in this chart, the bottom line in dark blue is dated Brent put on the same timestamp, the same time of day as these US prices. And then in light blue, you've got WTI, delivered at Cushing. And then at the top light blue line is WTI FOB Houston. That's the actual export value of crude. And as you can see, it has traded at quite a significant premium to those other locations in the last couple of months. There's a reason why we haven't seen a flood of US crude hitting the international markets, and that's that actually on a relative basis, it's not been the best value to a lot of the international markets. We have seen it go to Japan, we have seen it go to Italy. But in fact, it hasn't been the cheapest crude that you could get at that level. Now, this value is going to be extremely important in the years ahead. If US crude is going to be a defining feature of international benchmarks, then this needs to be a competitive international crude more often. It can't just be a sporadically relevant price to the rest of the world. That's why we've started publishing this. We want to see how it performs in the international markets. But the reality is, at the moment, the most important crudes are still those that we see regularly in the international markets on vessels that can be transported around the world. Okay, I'm just going to mention lastly, just because, well, because I'm selfish and it's a big part of my life, but I'm going to Houston next week because we are changing the timings of our assessments in the US. And it's a big project for us, may not be relevant to lots of people, but for any of those who do look at the US markets, this is an important thing because it means that Platts US assessments are coming in line with the prevailing futures settlement point of the day in the US, which is 2:30 p.m. New York time. As I say, may not be relevant to lots of people, but it's, well, I've got to go to Houston, so, you know.